Hello, have you ever wondered whether you should use a mortgage provider or a mortgage broker? Well, you're here today with Charlie Miller to help you answer that question. Charlie, thanks so much for joining us. Can you tell us a little bit about Fortress Group and mortgage? What is a mortgage broker?
Yeah, so thanks for having me, Taylor. My name is Charlie Miller. I'm with the Fortress Group, Total Home Finance. We are a small family owned and operated brokerage based out of Maryland, but we do loans in DC, Maryland, Virginia, Delaware, my team in Florida, Texas, the Carolinas. So kind of all that mid-Atlantic and down south market. We have been open and operating for coming up on about 3.5, coming up on 4 years this summer. So I started doing mortgages when I was right outside of college. I was an intern for a big bank, Wells Fargo, home lending in college. I started doing mortgages right after that. I was there for about 5 years, left there about 10 years ago, went to a small mortgage company. At that time, now it's a pretty big mortgage company called Movement Mortgage. And then he was there for a few
Oh,
years, went to Freedom Mortgage, got a couple companies that we got acquired. And so we ended up deciding to do our own brokerage about coming up on about 4 years ago. So it's been a fun ride and it's been pretty cool. We've learned a lot too. But it's been fun seeing the big or having the aspect and the experience of seeing how big banks do it, how small mortgage companies do it, how medium-sized mortgage companies do it, and then now on the broker side. So it's been
yeah.
pretty
So
cool.
you've had experience in the full gamut of
All
all
of
the
it.
different types of lenders, which is great, I would imagine. It's given
Yeah,
you
it's
insight.
fun. A lot of insight. And again, I mean, there's no kind of like we were just chatting about before the call, there's no 100% right answer when it comes to what company you absolutely should work with every scenario or every situation. Everybody has a unique situation. Every seller's different, every house is different, every buyer's different. And catering that to your specific needs is something that we wanted to do as a brokerage because it gives us, I like to say, maximum optionality. So we kind of have an option for every scenario or situation. It may or may not be the best exact one, but it does give us an option that we can present to you to see if it works for your situation. So the broker
So
world is definitely.
yeah, then maybe delve in a little bit. What is the difference between a broker and what might be termed a traditional mortgage provider?
Right. So you've got big banks like Wells Fargo, Bank of America, PNC. So those are large financial institutions, right? Depository institutions. Then you've got credit unions. They kind of operate relatively similar to larger institutions, banking institutions. You have mortgage companies that are called correspondent lenders that work directly with Fannie Mae and Freddie Mac. So there's a ton of really good mortgage companies in our market. They do a really good job, a lot of really good loan officers, but they're essentially funding everything in their name and doing most everything internally under their umbrella. Whereas brokers, what we do is we partner with a ton of different large organizations or institutions where we are the person going and finding the client, helping walk them through the process, but ultimately using that wholesale lender to fund the loan. So it gives us the option to shop rates and programs with dozens of different companies to find a good situation for most people's needs.
Great. So there's more choice with you.
Definitely more choice. So it's a lot more, it can be more involved you don't necessarily see it on the
Right.
consumer end, but on our end, when we're constantly taking your situation, running it through multiple different lenders, systems to really find out, the best rate that we can possibly get you. So usually we have the capability of savings. Now, since we're such a small company, another benefit there is we don't have the big middle management or corporate structure. So for example, as kind of a traditional mortgage company, you would have a loan officer and maybe an assistant or a processor, but then you have a branch manager, an area manager, a regional manager, a divisional manager, a national manager, and then you got presidents and CEOs. And all those people, although they provide a ton of support and value, they aren't necessarily originating loans, but they're still making money. And so that has to come off of typically, and it has to be paid somehow. And so
Hmm.
typically that allows us to really keep our margins very tight by not having that additional overhead and passing those savings on to the consumer.
Nice. Nice. So there are some areas where you are not able to do things, as we mentioned before, like the Maryland mortgage, some home buyer assistance programs that are state or county operated. But you do have some internal options that may be a good substitute for those. Is that right?
Sure. Yeah. I mean, there's no such thing as the ideal place for everybody's scenario,
Right.
right? So, for example, like we were chatting about a little bit, is relationship banking. So I worked at Wells Fargo and for years, and I've been on the board of the Mortgage Bankers Association for years as well in Maryland. I still oversee kind of the Young Professionals Network there. Even though my hair is all turning gray, somehow I still, I'm young enough, I guess, for another couple of
Yeah.
years. So I have a ton of good relationships with a lot of different loan officers, lending organizations, companies, banking institutions. And so we have conversations about what they I really have an appetite for at the time and what they're focused on. And big banks, a good example where sometimes we'll always have an option, may not be the exact best option, but if you're buying a $3 million home, and you have $1 million in the bank with your banking institution, they'll very likely have relationship pricing or discounts by you having a bank account with them with a lot of money in that account. So they'll kind of do it as a loss leader where they'll provide a very good interest rate on your mortgage to retain your business in other avenues in other areas. The Maryland Mortgage Program, down payment assistance. So brokers in general, because we're not ultimately funding the loan in our name, we don't technically have relationships or capacities a lot of times to work with certain down payment assistance programs through certain cities, counties, states. That is starting to grow and expand just because the prints has grown so much. So a quick offshoot on that, roughly close to not quite 1 in 3, it's about right under 30% of mortgages originated are done by a broker now. So that
Wow.
just shows how powerful the platform is. Now think about how many banks there are, how many credit unions there are, how many mortgage companies there are. The fact that almost 30% of mortgages originated were done by a broker is really, hats off to a huge thing. It's grown. 10 years ago, you're probably looking at under 10%, probably 8 or 9% of loans were done by a mortgage broker. And now,
My
10 years
first
later,
mortgage was through a broker.
yeah, so you
20.
saw a shift, right? So you did see a shift. So you had a ton of brokers back in the 90s, early 2000s, and then the collapse happened. You saw, Dodd-Frank, Wall Street Reform Act come out, and then that really made a lot of brokers nervous. They wanted to be at an institution that had the financial backing to support them during that time. So you saw a lot of mortgage brokers kind of really shrink during that time. And then you really saw an explosion over the last 10 years, I think specifically because of COVID and technology, right? People
Mm,
realized that they didn't necessarily have to go into the office every day to help people and to continue to do business and technology. Now we're at a place where we can be anywhere. We can plug into these different lender systems very easily and have the tech support to be able to do things seamlessly. Now, jumping back real quick to down payment assistance programs. Yeah, most brokers in general will not be able to partner with like the VHDA in Virginia or Maryland Mortgage Program. Now, there are certain ones that they're starting to launch into, but what you do on the opposite side is you partner with a company that does something like that internally, right? So like Cardinal, they have a down payment assistance program where you can get up to 3 or 4%, depending on the scenario, to help with down payment and closing costs. Now, there are income restrictions. There's no such thing as a free lunch, right?
right.
So, yes, you can get money through these programs, but typically they control the interest rates, which can be slightly elevated or a little bit higher because of the risk associated with the entire profile. But there are some really good outlets for people that have, saved up good money or haven't saved up a ton of money, but make, decent money, have, done a good job building their credit. But just because of how there's a lot of good options for people that haven't had the capacity to save money because of how expensive life is right now.
Right.
So again, at the end of the day, If you need money, then there are some options. If you don't, typically you can save on interest rates and just overall loan costs if you're able to come up with a down payment and closing costs on your own.
So one thing that I really like about working with you is that, as you sort of alluded to, you're smaller, and there's a lot more hands-on. Really, like you're attentive. It's you and your helper that are really working with the clients, not all these unknown folks. Um, and so there's that sort of more personal approach. I suppose, though, maybe if you're going with all these third party, you're not doing it in house, so you don't necessarily have control over certain stages of the application process the way another company might. So it's just important to be aware of that. It isn't necessarily a drawback, right?
Mhm.
It's the way that it works.
So I can kind of jump in there in a little bit and explain some of that. So that was always some of our biggest hesitation around going to the broker world. And when we were really looking into it, it was okay. Well, when we worked at Wells Fargo and mortgage companies, we'd always sell that against why you would not want to work with a broker, right?
Right.
So you go to a broker because they're not underwriting the loan in house, they're not closing the loan in house. But what I've come to learn is that it's actually as wild as this sounds, it's actually a little. I feel like I have much more control over the loans on this side because I am able to do it all. Meaning from the initial application, we review everything, we can submit loans directly to underwriting. So for example, a standard workflow at let's say a big bank, a loan officer takes a loan application, they disclose, the customer signs, they send all their income and asset documentation, then they provide it to the loan officer provides it to a processor. The processor might take 2 to 5 days to review that. Processor submits it to underwriting. 2 to 5 days later, an underwriter reviews it, provides an approval. Now you're 7 to 10 days into the transaction where you get your commitment. And then the processor a lot of times will be ordering the title, insurance, the appraisal. Whereas on our end, so I take your application today, I send you your disclosures today, tomorrow, you sign them, I have your income and asset documentation, I submit it directly to underwriting. So within 24 to 48 hours, we have that commitment. I order the appraisal, the title, and insurance. And within 24 to 48 hours, your appraisal's ordered, title's ordered, insurance is ordered, and you already have an additional loan conditional approval. So I've actually learned that, yes, there are certain lenders that do it better and do things faster that we work with. So, and we know that. So we have relationships with lenders that will do a loan in literally 2 weeks every time. And we have some that might take 30 days, but they
Hmm.
might have a really unique ARM product at a very low interest rate. So as long as we're able to structure that and we're aware of that, we know how to make the scenario work. And
And
then
if
last
that's something that's really important to the client, right, then that's the better option. Yep.
right? So if you're not in a rush and there's a lender that has a 5-1 arm at 5.25%, but they might take 25 days on average to do a loan, and we're kind of pushing them along the whole way. As long as you know that and you structure that when you make an offer on a home, not to close in 2 weeks, there you go. Or if you want to close in 2 weeks, that's fine, and then we just flip it to somebody else that has that standard workflow. And the last thing I'll say on it is, again, we're working with dozens of different lenders and they are all competing for our business. So that's kind of been
Hmm.
the biggest difference. So we are those or those wholesale lenders' sales force, right?
Yeah.
So if I don't send a loan to this lender, then and I go somewhere else, they're asking why or how can we get your next transaction or your next client. So these people are constantly improving their price, improving their technology, improving their workflow, are doing everything that they can to earn our business. So if they don't, perform for a valid reason, then we just won't work with them again, right? So, and they know that. And so because of that, it's not a bickering, fighting with, hey, you're supposed to be processing this loan, underwriting this loan, like I used to have at certain entities that are institutions I would work at. It's like, no, we're going to do everything we can because we want you to send us your next transaction because we know you can just send it somewhere else.
Right.
So there's been that shift to where, yeah, sure, 10 years ago, I would have said the same thing that you lose a little bit of control. But now, because of technology and how fast things can be done, and because we have complete control of when it gets submitted to underwriting and how we go about getting the conditions from the consumer and resubmitting it to underwriting, we're able to do things, I mean, faster than ever any other mortgage company I've worked at. But it all comes back to us on how quickly we do it. So it gives us complete control and power.
That's great. And because you have developed the relationships with these different providers, you really know like who's the best, right? Over the years, you've figured out that well, maybe this company is not one that we really want to work with, but this company is always spot on, and we know that they're going to treat the client well, and we're going to get there, and they're competitive with their rates and all that kind of stuff, right? So. Um, you in many ways have done the homework for the applicant. Like there's no
That's a good way
way
to
that
think.
some if I'm applying for a loan, there's no way that I can apply to all the different companies that you have access to. But you already know those companies and know which of them are the best for that specific scenario.
Exactly. That's a good way to put it, Taylor. And yeah, I mean, at the end of the day, we we don't sign up or work with companies that we don't like, know, or trust. And if we have a bad experience, we get that resolved immediately. We don't work with them again. And ultimately, it all comes back to us. So our reputation, our livelihoods, all of that is down to the line of getting the transaction done and making sure that everybody has a good experience. Whereas some of these larger organizations, you might be getting leads or referrals because of the institution, like because you bank with Wells Fargo,
Right.
you know, um, or because they have such a big brand name. We don't have the luxury of having that big brand name, but we have the luxury of being able to do everything ourselves and make things happen quickly and take complete ownership of the file. So it's been a learning curve. Again, there's certain ways that that can be a positive to a loan officer. So if you're looking at this as a loan officer versus a consumer, it's a different conversation. Um, but it's been a lot of fun. We've had a lot of fun being broker on the broker world. We've learned a ton. We've been able to help a lot of people and save a lot of people a lot of money because of some of the things that we we're talking about with shopping rates and tighter margins and things of that nature. Um, so we've enjoyed
Great.
it.
Great.
Yeah.
And I want to stress too that that you're local, you're family owned, you are a small business. You know, it's very important to you that your client is happy, and
Oh,
you
absolutely.
know
That's what
it's
we do.
you're talking about the lenders being it's important to them that you're happy, but it's really even more important to you that your clients are happy because your name's on this. This is your livelihood and your business and in your neighborhood, so to speak, right? So
Yeah, so 100% Taylor. I mean, that's like without me and a couple of our, loan officers that are with us, without the two or three or four of us, the company doesn't exist, right? So we are the company. And, we take that very seriously and very personally, whether that's a good thing to do or not in this industry, but we do because we ultimately do care. Um, but I appreciate having me on today, Taylor. And is there any other kind of questions or thoughts or things that you wanted to discuss?
no, I think maybe we just wrap up with again, Charlie. Thank you for your time. I think this was very valuable. And anybody watching this, if you found this helpful, please hit the like button and maybe subscribe to the YouTube channel. Our contact information will be below, so you could reach out to Charlie or me for help. Um, Charlie, what if somebody is maybe 6 months to a year out from buying, they think that's their timeline. What are some suggestions you might have that they would be good for them to think about doing in the next year?
So, first off, it's never too early to have a conversation, right? So, you want to position yourself in a way that you are ready to move forward very quickly with a strong offer, and you're not rushing at the last minute. So, If you're not thinking about buying a home for a year, that's completely fine. We have a free consultation where we sit down, whether in person, over the phone, Zoom, and we go through everything. We go through everything that goes into qualifying for a mortgage, loan programs, costs, monthly payments, overall next steps. And we kind of just take a 30 to 45-minute conversation so you have a really good baseline understanding of what goes into qualifying, what programs are available to you, and what to expect on the numbers when it comes to down payment, cash to close, and monthly payments.
Mm-hmm.
So that's the first thing I would do. And then after that, when you're ready, is you would go through all of that in the form of a written loan application and actually applying for a mortgage to get pre-approved. Pre-approvals are free. I can't say that with every single lender they are, but a majority of lenders provide pre-approvals for free or no cost. And there's no obligation. Right? So if you don't end up buying a home or working with us, that's completely fine. It just allows you to make sure that you know you qualify for a loan. Pre-approvals are really, there's no
And it
really.
gives you a sense of what your price point is, which is
No,
important.
100%. Your comfort
Yeah.
level, how much you can qualify for, and what you're comfortable spending can sometimes be a very drastic thing, different
Yeah.
too.
Yeah.
You might be able to qualify for a $6,000 mortgage, but you only want to spend 3,500 or 2,500. And so what does that correlate to in price range? And we have those conversations. But a pre-approval is a snapshot in time, right? So if I pre-approve Taylor Johnson for a mortgage today, it's based on your credit, your income, and your assets right now. If you quit your job tomorrow or you finance a new car, or if you got to make a payment, your credit drops, that's going to impact things moving forward. So once you get pre-approved, you want to try to keep everything on your financial picture very similar throughout the process to avoid any hiccups. But getting pre-approved again, it's called no cost, no obligation. We can even start with what's called a soft pull on your credit. So it's not a hard inquiry or have any negative or a detriment to your credit scores. So it allows us to look at your credit scores, your debts, make sure you qualify for a loan and provide a pre-approval.
Make sure there are
So
no
that can
skeletons in that credit closet.
exactly, and then you're good to go, and you have
Yeah.
that peace of mind. And it's not all of a sudden, hey, Charlie, I just saw this house. We've never talked, we've never spoken before. I don't really know what I'm doing. I want to make an offer on this house tonight, but I also now have to get pre-approved, and they're trying to do all these things all at once, and
Hmm.
everything's rushed. You can make the experience better than that, just by being proactive. So starting number one with the conversation. Second thing, taking that conversation into a loan application whenever you're ready. And I typically tell people if you're actively in the market looking for homes, get pre-approved
Yeah.
because a lot of times something might show up that's the one, on the first
I
try.
say the same.
Sometime
Yeah.
it might take 6 months,
If
but
you
you just
fall in
don't
love,
know.
you want to be able to do it, right?
You want to be able to do it quickly.
Yep.
You don't want it to be Friday night at 7 o'clock. You just left looking at the property. You want to make an offer Saturday and now you can't get a hold of somebody. So you want to just make sure that you have all the ducks in a row, and that starts a conversation, leads to pre-approval, and then that way you're structured and ready to go very quickly, and you have
Yeah.
that peace of mind and that confidence.
Super. All
So
right.
conversation, that's going to be the first thing I recommend because we can tell
Okay.
you without pulling your credit, without you pulling all your pay stubs and W-2s and bank statements, having to put all this documentation, I can have a conversation with you and tell you exactly kind of what you should do, why or why not, so you can make an informed decision for what's best for you and your family.
Awesome. Great advice. Thank you so much. Again, Charlie Miller with the Fortress Group. I'm Taylor Johnson with Keller Williams Capital Properties. We are both here to be a resource for you in the DC, Maryland, Virginia area. Please reach out to us. Thanks again, Charlie.
Thank you, Taylor. Chat to you soon.